Hello, everyone, and welcome to our webinar today on working with a tax preparer. My name is Sarah Campbell. I'm with the Farm Service Agency at USDA, and we are hosting this webinar as part of our partnership with the National Farm Income Tax Extension Committee. FSA houses USDA's Farm Tax Education and Asset Protection Initiative. So we have monthly webinars on timely and relevant tax topics, and a lot of informational materials for producers and the folks who work with farmers on farmers.gov/taxes. So I encourage folks to visit that website. This webinar is being recorded. The slides and any relevant materials and the recording will be posted on farmers.gov/taxes. It just takes us 1 to 2 weeks because we have to caption those and get all those files ready to be put online. We also have a YouTube channel where you can watch previous videos on critical tax topics or recent uh, disaster programs and tax implications of those, and pretty much everything ag taxes. There's materials that are more advanced as well as those for beginners. So we recommend folks please explore those resources. You'll be able to rewatch this and revisit the materials. If during the presentation you have questions, please drop them in the Q&A box and we will answer those at the end. So I'm going to hand it over to Kevin Burkett to talk to you all about working with a tax preparer.
All right. Yeah, sounds good. Thanks, Sarah and Janet, for the invitation to speak to the group today. And we just want to go through some basic information about kind of working with a third party, somebody that's going to work and file your taxes for you. We always seem to get some questions about things like this time of year, both from a kind of like a tax planning and a tax management standpoint. And we also get some questions about like how do I find someone to work with and things like that. So we felt like this would be relevant this time of year as we start to close out the year and we start to think about some of the tax filings and things that we need to do. And so I'm going to go through some basic information today, also give you some resources that hopefully as you progress further, they'll help you in your journey. As Sarah mentioned, I am part of the rural tax group that provides education in this area. My full-time position is with Clemson University as an extension associate. I do have my CPA license and I work with the Clemson Tax Schools here, which is a continuing education program for tax professionals across South Carolina. So I have some background and experience in this area and just want to share some of that with you all today. So just real quick, I'll just mention and highlight the group that we work with, which is the Rural Tax Group. Some of our information and like our publications and things that we try to provide education through, that's housed through Utah State University. And so ruraltax.org or that QR code would take you to the website where you can find more information about the committee and a lot of the articles and things that have been published. We're currently in process as far as revamping some of those materials, but also trying to put out new information as new questions come up or new situations come up, or if we get something that's frequently asked, just try to add supplementary information as we go along. So you can see some of the things that are listed on that website, but if you've never visited, would probably encourage you to do so. And that group is working with USDA as part of this cooperative agreement. So they wanted to do some tax education for farmers and new farmers. And it is a question that comes up a lot and something that can be a confusing area and a confusing topic. So this is not necessarily views of the USDA, and we are just doing this from an educational perspective. So we're going to share the best information, most up-to-date and accurate information as we can today. And it's just part of this working agreement with USDA to do education in this area. So just kind of a few quick notes about that. And just as an example of things that we try to do. So we're doing the webinar version today. A little bit earlier this year, we did write an article on a very similar question or very similar topic, which is working with the tax professional. So if you'd like to, that's like a 1 page or so document, And it's really the type of information we're going to cover for today. But there on the Rural Tax website, you can find the article version of some of what we're going to cover today. So just you can see the past webinars through farmers.gov/taxes, or through the website, or through Rural Tax. That information is out there. So this is a question we get a lot. Well, how do I find someone to work with, or do you currently have someone that you are working with? And generally, for farmers, especially new farmers, and really you could almost say for a lot of small business owners, you have a lot of demands on your time. You're probably worried about production of the farm. You might be working with employees. You might have food safety issues. You might have a lot of other things that you're trying to work through as a small farm owner, as a small business owner. And so generally, unless someone has just a real interest in this area or a lot of time to devote to this area, generally we would recommend working with a tax professional. And so then the next question would be, well, how do I find somebody if I do need someone? And so there again, there is a rural tax article from one of our colleagues, Dr. Cushing, on how to choose a tax professional. It just talks about some of the credentials, some of the questions, some of the things that you may want to consider when you get in touch with someone. What do you want to evaluate, and maybe how do you get the best value out of that relationship? And if I'm not mistaken, I think they may have done a previous webinar for farmers.gov as well. So there again, you've got the article, or if you've got a previous recording of that you can take a look at. But just a couple resources in that regard. So irs.gov, they do have some information out there on a listing of tax professionals really across the United States. But they've also got some information on what are the different credentials as far as tax professionals. So generally you've got enrolled agents, you've got certified public accountants or CPAs, you've got lawyers that work in the area of tax. And so what do each of those credentials mean? What does it mean as far as them practicing before the IRS? So on their website, they have like a listing of that, and then a listing of that same thing of like, how do you evaluate someone to work with and find someone to work with? Depending on your, we don't know necessarily where everybody is located, but generally you're going to have a state society of CPAs. That could be a good organization to get in touch with, and you can say, hey, I'm in this particular area or particular town or something like that, and they may be able to share with you, well, this is the listing of CPAs that we have in this area, for instance. But one of the best ways, and maybe the most effective, because you can talk to people that are maybe similar to you. They may be a new farmer as well, or they may be somebody in your neighborhood or in your town. And if they've got a similar business or the same kind of situations or questions and things as you, then just speaking to them and say, hey, do you have somebody that you work with? What's been your experience? Those sorts of things. Then working with colleagues or word of mouth can really be one of the best ways to find that out. But what I would say is, if you've got a farm, if you've got a small farm, somebody that does have experience in the farming area is going to be, I think, it's going to be an advantage, certainly. And there's just some things related to farm taxation, and that's kind of why we do these educational webinars and things. But there are just some things related to farm taxation that's a little bit different, some provisions and things that farms can take advantage of, that it's very valuable if they have that experience in working with other farmers. So that's something else to consider. And the biggest takeaways, I would say, as far as working with someone and getting the best value and having the best relationship with them is, if there's really just two takeaways, I would just say it's communication with that third party, with that tax professional, and it's record keeping. And hopefully, as we kind of walk through this, you'll see, kind of what I'm mentioning here, and it'll make sense from that standpoint. But really, good communication with that person, and then the record keeping from the standpoint of the farm and the business those two things I think make the biggest difference as far as what that relationship is like. And while we are focused on, the purpose of today, the purpose of these webinars and the educational piece that we're doing, we're focused on the tax information and kind of what are the implications of that. However, I would say if you're doing a good job as far as communication and record keeping, for the standpoint of tax information, you're going to have like the financials and things that you need and be able to pull that out of your business for other situations where you might need it. So if you're sitting down with a banker, if you've got something related to insurance that has come up, perhaps it's departments of agriculture, whether USDA or your state departments of agriculture, if they're asking you maybe for some kind of verification or documentation from your operation, and kind of speaking from the financial standpoint, obviously we might have production records or food safety records or things that are a little bit outside the realm of what we're talking about. But for these other third parties that we might work with, if we've really got the right information and good information and clean information from a tax record keeping standpoint, it's going to serve in a lot of these other areas as well. So, and a lot of times they may be asking you for like your Schedule F tax form and things. And so if we've got good information from that standpoint, it'll help for taxes certainly, but I think there's some of these other times where it's really going to come in handy too. So this is not really a record keeping presentation, but I do think it's important just to highlight some basics and kind of walk through maybe some examples of why and how this information gets used. So if you do not already have a separate business bank account for your farm, that's really the first step and would always be a recommendation is to set that up. And typically, if you're already banking with someone, a particular bank from a personal standpoint, you can certainly ask them, what are their business bank options? What are their business accounts like? Typically, it's free. It's not overly difficult to set up that account. And it may be you decide to go with another bank for whatever reason, but typically there's not any additional charge for that account. And you just say, I've got this farm or this other small business, and they may ask you for an EIN or something like that, an employer identification number, which you get through the IRS. But that's typically pretty easy to set up. And so then you really just want to run all of your financial transactions through that account. And so we make sure that anything that's happening with the business is being captured through that business bank account. And, it might be you, just a sole proprietor, and you're really responsible for everything that's going on with the farm, but you may also have other family members. It might be your spouse, it might be a brother, it might be just some other family member or another co-owner. And it's important that all of you then would have access to that account and be running all of the transactions through the account. So probably you might have a debit card or a credit card or something like that to make purchases for the farm, making sure everybody has one of those and is connected to that account. Again, just to make sure everything is being run through that. But it's really critical because it keeps your personal information separate from your business information. So, if we went to, say, Walmart or just really any other store, we could be purchasing things that some things are related to the business and then some things might be of a personal nature. And so, if it was a week ago, we might be pretty clear about, well, yeah, roughly half of this was business and roughly half of this was personal. But if we have, say, hundreds of transactions through the year, and if we go back and let's say it was a transaction back in January and we're trying to piece through and figure out, was that business or was that personal? It really becomes a challenge and can really be a headache for you or anyone else that's trying to like sift through these records. And so it just keeps all of that separate. So anything that's personal is run through your personal account. Anything that relates to the farm is run through that business account. The other thing related to that is perhaps you've got several different businesses that you're running as well. And so we might have the farm account, but perhaps your spouse has another small business that they're running and it's totally separate from what's going on with the farm, then we would want to separate those into two different business accounts because there again, if you've got them kind of intermingled, going back and picking through, well, what was farm and what was the other small business, that can really be a challenge from that standpoint. So perhaps you already do have this account and you've already been using it, in which case that's great, but just something I wanted to mention here. So, but it keeps a tally of all the money related to the business, and it's really the start of good record keeping. And so sometimes too, we'll get a question of like, well, if I've started the account, but I don't have a lot of sales or anything, how do I keep track of that? Or how do I make purchases and things? So if you need to make contributions to that business and to that business account, essentially you would take a certain amount of money, say $5,000 or $10,000, you would make a contribution from your personal account to that business account. But then we have record of, well, this is how much the owners have contributed, which is important for keeping track of your equity and your ownership in the business. Same thing there might be times where you're taking money out of the business and it goes from your business bank account to your personal bank account. But there again, we have a record of that. So it might have been a funds transfer. It might have been a check from one direction or another, but we still have record of when that took place, what the amounts were, and things like that. And so most small businesses, I think 99% of farms are going to be on the cash method of accounting. And I'm not really going to touch on that, but you may hear it periodically, which basically means anytime money changes hands in the business. So if you've paid someone, then we record a transaction in the business. Or if you've made a sale and cash has come into the business, we're going to record like a sale of products at that point. So anytime money actually changes hands from your business to another, then a transaction is recorded. And so transactions are then input into a ledger, and a ledger would just be an accounting record or an accounting book of all the different things that have occurred through the year. So just as an example here, so let's say, we've got that separate business bank account set up, and at the beginning of the year, we went to the co-op and we've made a $1,200 purchase on January the 18th. And so we've got some basic information here. We know that we know where it was purchased. We know the date that it was purchased, and we even know the total amount that was purchased. But what else do you need to know about that? And if we were in person, I might ask you to respond, but obviously we're doing this through Zoom today. So I'll just kind of just keep working through the example here. But so we do have some basic information and some important information as far as like some basics about that transaction, but really we want to know what made up that expense. What are the things that we purchased? What potentially quantities did we purchase? What was the price of these different items? But from a record keeping standpoint, we want to be able to break out our expenses as far as what we purchased. And so I'm going to assume that when we made that purchase that, yes, all of these things were going to our business bank account, and all of these things were things that we were purchasing for the farm. And so as an example, say $450, we're going to make repairs to our fence, and it related to fencing. $400 related to irrigation that you've got on the farm. And then $350 was seeds and plants, which is just what you're going to be growing for this year. And so you made a purchase for that. So we've got more of that detail. And even within our accounting records, we can add additional detail to say exactly how much of those particular items were purchased. So if it was 1,000 seeds of a particular plant, then we can include that in the records of the business. And so let's say we've got the purchase on January the 18th where we had $350 of seeds and plants. But then let's say at the beginning of February, we have another purchase. We went back to the co-op, we purchased $300 more of seeds and plants. And so at that time, we need to know really what's been our total as far as seeds and plants expense that we've got throughout the year. So I'll just assume that we didn't make any other purchases. And so in total for 2024, for instance, we would have $650 of seeds and plants expense for this year. And so if we only had the bank information and we didn't record this in some kind of an account book or in some kind of a ledger, we would have to pick through and like separate all those out, and to go through all of those transactions like at one time at the end of the year would really be a challenge. And so it's captured through the accounting records of the business. But so let's say we've got those two transactions, they've been recorded, and then this is our tax form that we use to file information related to our farm business, the Schedule F form, which is where that information is reported. And so $650. So on line 26 of the form, you can see there's a breakout for our seeds and plants expense for the year. And so $650 would then be input into that expense category for the Schedule F. And so you can set up your accounting records in such a way that really it mirrors this form, and the expenses that are listed on this form, they're captured through the accounting records of your business. And so it may be that, I think there's approximately 22 or so expense lines there in part two. You may have most of those, you may have half of those, you may have a small portion of those. It just depends on what your particular operation is, how active you are maybe during the year, and just what applies to your farm. But it is important, and it is good to then break it out into these actual expense categories. So there may be other things like line 14, for instance, is depreciation and like 179 expense. And so that's a little bit more of a calculation. We have to know what our equipment balances are, what our equipment purchases were during the year. And that may be where a tax preparer is going to take that information, and then they're going to make that calculation for you as far as what ends up on line 14 for your depreciation expense. But having those good, clean records up front is really going to help from that standpoint. So, so just to kind of like point that out of how, going through that bank system first, and then going through the accounting records, and then really that is what ends up then on your tax return. So we generally get a question too of like, well, what kind of record keeping system do I have, or what kind of records do I have to have? And this is straight from the IRS, and there's a publication 583. It's Starting a Business and Keeping Records. It's about 20 or so pages. And so if you're just getting started, or if you've maybe never seen this publication before, you may want to take a look at it. But in that publication, it says you can choose any record keeping system suited to your business that clearly shows your income and expenses. So you really have some freedom from that standpoint as far as what you want to use. And, sometimes a certain system makes sense to somebody else, but it may be completely confusing to another person. And if they have a system that they like to use and they're comfortable with it and they're consistent about using it, then great. And if it makes sense to them and they can get the information out of it that they need, then that's a good system for them. So really the objectives are any type of system that clearly shows your income and expenses. And so we do work with producers. We'll sit down with them and try to help them in this area. Maybe they're just getting started. They've got the business bank account, but then they're not exactly sure what to do with some of those transactions. So a manual account book, which would be almost like a printed manual, I haven't seen that a lot, but there are some maybe a little bit older producers that they are comfortable and they've used that for a while. Maybe they don't have a lot of transactions. And so that's really the best way for them. It's almost like keeping a checkbook or something like that, but they're comfortable with that. They use it. And so if that works for them, great. Some other things you might see would be like an Excel spreadsheet or a Google sheet. There are templates that you can find that may be a head start on some of that, or you can create something completely from scratch that, again, if it makes sense to you, it captures the right information, the information that you need, that's great. This is something that a colleague, he had a previous spreadsheet. It was more related to high tunnel production, but we modified it just a little bit. And I think just about any type of operation could use this spreadsheet. It's on our Clemson Extension agribusiness webpage. I'm glad to share a link to this resource, and there is a short YouTube video associated with it as well. But you can kind of see there's some instructions there just on the front page, but you can set up your chart of accounts, which is the second tab, and then it's got a listing for each month where each time you've got a transaction, you enter that into the Excel file, and it keeps a running tally of everything that's happened throughout the year for you. So at the very last couple of tabs is like a profit and loss statement. And so, and expense categories and expense totals for you. So you might get to March and you might say, well, yeah, I'd like to know how much I've spent on seeds and plants at this point. That separate tab that's keeping that running tally can show you that. But also, if you need to go back into March and look at a particular transaction, make sure it's correct, or maybe you missed a transaction or something, you enter it into the March tab of the spreadsheet and it'll populate those other areas. So there's a number of resources that are kind of like this that are out there. This is just one that I'm aware of that we work with some producers on. But again, whatever you feel most comfortable with is going to be the best system. So I just wanted to mention a couple of these others because these are things that we maybe commonly see a lot. And I'm not making a recommendation one way or the other, but again, we do get the question of like, what are some systems that I can use? Do you have any that you've got experience with and things like that? So the first three, Xero, Bench, and Wave, I say free-ish because I think they've got a really basic and simple version. And if you're just starting out and if you don't have a lot of transaction, that may be a good system for you. As you develop a little bit more or as you have more transactions, I think you start to pay for some of those features, and it might be number of entries, or it might just be certain features that you start to need, whether it be like importing bank transactions or something like that. Then you start to pay for some of those additional features. So I think they have a really basic version that is free, and then you kind of add on things that you need as you need them. QuickBooks and Quicken, probably the most formal accounting softwares and maybe the ones that you've heard of probably most frequently. They have a lot of good features. They're really good about like cloud-based accounting. They're really good about being able to integrate with a lot of other softwares and a lot of other programs. Any tax preparer that you work with, they're probably very comfortable with these files as far as receiving them and being able to work with them. But generally, they're probably also going to be the most expensive, and in some ways could be the most complex as far as if you're trying to figure out a system and you're starting from scratch and you don't have much experience with anything like that. They could be a challenge to learn from that standpoint. It's not impossible by any means, but just the way that they're set up. There's a couple others that are really tailored to agriculture operations, and so those are the four listed there. So the PC Mars, Ag Squared, Ambrook, and Traction Ag. I haven't worked with all of these personally, but I just know that they do lend themselves to working with farm businesses. And so there again, I won't make a recommendation or anything like that, but if you're looking for something that, QuickBooks and Quicken can just be tailored to just about any type of business. These others, they recognize that ag is a little bit different. It already has some features of maybe sales of products. It already includes things like livestock or grains or things like that. And so it's just recognizing that what's a farmer going to encounter, what's going to be important to a farmer from that standpoint. And, the other option would be that you've got a paid bookkeeping service of some kind. So it could be somebody in your family is doing this for you. It could be you've got someone around town that is a bookkeeper and will do this for you. And they're going to need access to like your business bank account and all the transactions and things that might happen during the year. I would say sometimes you can find like bookkeeping and tax services together, but not always. And I would say that's maybe less and less common. So it might be that you've got someone that's a bookkeeper for you, but then someone else then is actually going to prepare and file your taxes for you. So, that's another option. If you've got the funds or the resources to do that and you're more comfortable with somebody else handling it, that's an option too. So I just, again, not making a recommendation, just want to mention a couple resources from that standpoint. But whatever system that you have, basically we want to have good, clean records out of it because one, for you to be able to look at it and make decisions about your business and be able to analyze your profitability and things like that. But any tax preparer is then going to have to take that information in order to prepare your taxes. And so if they've got bad data or incomplete data or hardly any data, then it really becomes a challenge for them to complete your filings and things accurately and timely and everything like that. And just from a relationship standpoint and generally how they bill their services and things, just like maybe if you sat down with a lawyer, but generally the more time that they spend on it, the more expensive it becomes. And so there's going to be a little bit of time no matter what. Like there's going to be some calculations. They're going to maybe do some checks and different things, make sure that they feel like things are accurate and things like that. There's going to be a little bit of time spent filling out the forms and filing the forms, those sorts of things. But if they're spending, say, hours and hours on the records in order to recreate those or to fill in incomplete information or something like that, well, your bill for their services starts to become more and more expensive from that standpoint. So, we always kind of joke about like the shoebox records and things like that. Well, if all they've got is like a handful of receipts and they somehow have to like try to recreate everything that happened during the year from that shoebox, one, it could take a lot of time, or they could just even refuse it entirely and say, we don't have the manpower or the resources in order to be able to work through this, especially if it's maybe a newer client and they don't have a relationship with you. They might just say, sorry, we don't have the capacity to do this. And so, and it might be if you've already worked with someone in the past or you currently have a relationship with them, they may have suggestions or requests as far as how you keep your records. They may say, yeah, we really like working with QuickBooks. I don't know if they could offer any sort of like discount or anything like that if you work with them through QuickBooks. Or they might just say, as long as we can get like a CSV file of your accounting records during the year, then we can import that. We can use it on our side with our software, and that's really all we need from that standpoint. But when you're talking to them, that might be a good question to ask. They may already have suggestions for you, but see what they're also comfortable with as well. And I would just say the clients that are easy to work with are generally going to receive better service, and not because like if they're spending a lot of time recreating the records, they haven't even really gotten to the tax preparation part of it yet. They're just spending time on this more like administrative task. And so they can spend more time maybe from a tax management and a tax planning standpoint, but also spending more time on the actual tax preparation as opposed to maybe all these other tasks and things that need to be taken care of first. So, but also when they think about working with you and you have good records, you have them timely and things like that, they're gonna, I would say, regard that as a positive interaction or a positive relationship. And then there's probably those clients that they don't want to see, and they kind of show up late each year. They kind of show up with bad information each year, and those are ones that are a little bit more of a challenge, I would say. So if you're more easy to work with, I would say just naturally you're going to receive probably better service from that. These are probably all the different ways that you might communicate with your tax professional. So if you've never worked with someone, probably the first thing you might do is just have a phone call to their office, just learn a little bit about them as far as maybe the size of their firm, what's their specialty, like do they have ag expertise, are they taking on new clients and things like that. Maybe you find out a little bit about what are their services, what are their fees, things like that. That probably goes into, if you're comfortable with that, then you would probably meet with them. It could be by Zoom. That might happen more and more frequently nowadays because a lot of information can be exchanged electronically, but it might also entail going to their office and actually having a visit with them. Generally, they're going to, it might be one or two people that are going to handle your information and be working with you through the process and like through the return. So you'll probably meet those people who might be working with you. There might be at times during the year, generally, we would recommend not just meeting with them come tax time, but actually having maybe a couple meetings throughout the year where you could even do some tax planning and things like that. And, if we've already completed the year, then all of our transactions have basically already happened. But especially say this time of year where we're you know 10 months through the year or so, but we've still got just a little bit of time where we can make some decisions and do some things before the end of the year that it can impact our tax situation. And we've through farmers.gov, we've done some webinars in the past on tax management, both before year end and after year end. So that may be another thing that you want to take a look at. But those planning meetings can happen, and it's not so much of a we just need information, we just need to get this filed sort of thing, but more of a casual conversation of what are your goals for the business. They can maybe make you aware of any possible negative consequences to that, or just tell you what your current situation is so you can have a better understanding of where you currently sit. And then an engagement letter. So this is going to be like if you decide to use their services, they're going to send you a letter basically that you would sign each year to say, this is what we are agreeing to as far as what we're going to file for you, what our fees are going to be, what our services are going to be, and those sorts of things. So that's an important document because you want to make sure you have a good understanding of how you're going to work with them. A document portal, this would be typically, seem like previously you might drop off like physical documents, but now a lot of times it is through an electronic system, and they want to make sure that they get those securely and that they're safe and data is not going where it should not be. So they may have requests as far as how you send information to them, and it's important for that reason so that it stays safe. And then after the filings, they may have a phone call with you or possibly a sit down just to review the information, make sure that they feel like it's accurate and complete, that you don't have any questions about it. And then they may file it for you. You may be taking it back to file it yourself, but they would kind of conclude the engagement at that point. And next steps would be possibly, there might be some estimated tax payments or things that in a couple months they want to make you aware of, or they may say, we would like to meet with you again this time next year to make sure we have everything up to date, that we are meeting your needs, that we're providing the services, and we agree on what services. That engagement letter is pretty much going to happen each year as far as what you're agreeing to, what services they're going to provide, and those kinds of things. But so, as I was kind of mentioning with a planning meeting, so typically they get past the deadline on October 15th, which is the 6-month extension of the April 15th deadline. And so after October 15th and before the end of the year, that can really be a good time to try and meet with them. And that's really the time period that we're in right now. We're getting a little bit close to the end of November, and then we just have 1 month left. But they typically are a little bit slower in that time. They're not in, say, the crunch of busy season, so they're trying to get filings done for just about every single one of their clients. And so this is a time where they may be able to help clean up some questions or maybe some bookkeeping situations that you're not totally sure about how to handle, or you want to make sure that you've got it handled correctly. And again, if you've, they can tell you kind of what your current situation is. And if you're thinking about, say, purchasing equipment or you're thinking about selling equipment, they can let you know, um, yeah, that's maybe a good idea, or maybe that's not a good idea. Maybe we want to hold off until the next year until we do something like that. Um, Again, those webinars and things that we talked about tax planning before the end of the year, that would dive into more specific situations and things that you might want to bring up or have questions about. But at that meeting, they would need a set of accounting records from the business. So they would need, let's say we decide that we're going to do it at the end of November, they would want to have up to date information at the end of November to evaluate, well, what has currently happened during the year. So they may not look at, say, every single transaction that's happened with the business, but being able to produce, say, a balance sheet or an income statement from that standpoint. And a lot of times, your accounting softwares would be able to provide this for you, but they may just take a look at that income statement, assuming it's correct and it's accurate and it's up to date, and they can say, okay, well, this is where, this is your profitability. Um, they'll probably ask you about other sources of income, whether it be, a lot of times we see farms that they work off the farm as well, or there might be another, the spouse has an off the farm job, or there's investment income, or there's rental income, or something like that. They would want to know and understand those other sources of income, because all of that feeds into your total taxable income from the year. And if you haven't looked at tax brackets or kind of understand how our progressive tax brackets work, I would encourage you to look into that, because that's really what feeds into some of our tax planning, is like, where do we currently sit and where are we currently being taxed at? What's our relation to like last year? What do we anticipate maybe happening in the future? And that really plays into a lot of our tax management strategies. But they would also want to know, like, were there any important changes in the business? Did somebody come in as owner? Did somebody leave as an owner? Was there any major plans or things that you want to happen before the end of the year? And if so, just discuss that with them, and they can give you an idea of, again, yeah, maybe that's a good time to do that, or hey, maybe we want to wait until next year. And obviously, there's a lot of things that go into that. If you're trying to make product sales by the end of the year and you've got a really good price, then the tax is a small consideration in comparison to some of those other things. But just from a tax management standpoint, you can at least be aware of what some of those implications are, and just have better understanding and better questions when you go to meet with that person. Uh, Kind of mentioned some of this already, but that engagement letter, it's really going to detail what services they are and are not providing to you. So it might be, if you're in business with, it might be you and maybe one or two other owners, and they have somebody that is going to prepare the business return, and then you're going to get your K1 or your ownership information from the other tax preparer and then bring it to your tax preparer. Then we know, like, they are not providing a business return for us, they're only doing our personal return. So that engagement letter really details, again, what they are and what they are not performing for you. Generally, it's going to include, okay, we're handling the 2024 tax filings, for instance, and it may detail each of those different returns that they're completing for you. Again, it may have the applicable rates or fees associated with doing those. There may be a flat fee for a certain type of return. There may be an hourly rate that's also included. They would probably also tell you what their expectations are as far as what documents they would expect to receive, when they might expect to receive those, how they might expect to receive those, like I mentioned, maybe through the electronic portal and things like that. So that engagement letter is an important communication. Generally, there might be a number of tax forms that you would receive during the year. Typically, we start to see these, like, they start to come in about January, but it might be 1098s, 1099s, K-1s, W-2s, W-4s, prior year tax returns, especially if you've never worked with them before. They're going to need all that information on hand in order to understand your situation and make sure, in a sense, they're not missing anything, that they capture everything accurately for the year. As we mentioned, a full set of accounting records from the business. So after we've completed the entire year, we want to make sure that basically we've got everything that happened from January until December 31, basically for the end of that year. They may not always need the backup documentation, which would include the receipts and invoices and copies of checks and maybe accounts and things. If all of that information has already been entered into your accounting records, they can go off those accounting records. And if they feel that that is accurate and complete and they're comfortable with that, that's what they're going to use. But there might be a situation where you purchase a piece of equipment or something, and they may just ask, hey, could we see that invoice? We want to make sure that we capture the total cost for the correct amount of depreciation or something like that. And the backup documentation really becomes important if the IRS were to ever to come in and ask questions about your return or something like that. They might say, okay, you indicated that you spent $4,000 on fertilizer for the year. Can you show us like the receipts or the invoices for that? And you say, yep, we purchased, $2,000 in February. We purchased $2,000 in April. Here's our 2 receipts for that. And that's kind of the end of the question or the end of the situation. So you just want to have that backup documentation on hand if you need it for some kind of request like that. I think we already kind of touched on this, but yeah, those big ticket items like asset sales or asset purchases, those are important. Anything related to possibly ownership changes, or even if you have to have ownership meetings and things, they maybe want to be aware of those. Loan balances are going to be important because they want to see, what were the amount of payments during the year, what are our current liabilities, but also for tax purposes, we want to know how much interest was paid on that loan because that's part of your deductions as well. And I think sometimes business owners, they assume that the accountant has all this information on hand, or somehow that like copies get sent to the accountant or something like that. But if a piece of equipment is purchased and it is not shared with, and so not sharing would be it's not entered into the accounting records of the business. It's not like an invoice or something like that is not shared with the preparer. Hopefully it would be entered into that business bank account. But if all you had was, say, a down payment of, say, $5,000, but the actual price of the equipment was, say, $45,000, well, we can see that we've got a $5,000 expense on the books, but we don't realize that an accountant may not realize that, well, we've also got, say, a $40,000 liability sitting out there. Perhaps we've paid interest or something during the year in relation to that equipment and in relation to that purchase. But essentially, if it's not shared, they're not going to have knowledge of it. And so it could cause delays in your tax filing. It could cause mistakes or even amending a return if it's kind of caught after the fact. So if the records are good, they would probably be able to piece through some of that and ask you some questions and get some of that follow-up documentation. But that's where, having these systems where we've got it in a bank account, where we've got it recorded in our accounting records, that's really going to be important. And so there again, that communication and that record keeping, I think, are the biggest factors as far as this relationship goes. So again, making their job easier, I would say, results in better service. Generally, a tax preparer, they are going to alert you to deadlines. And if you've been working with them for a while, they probably have some reminders and things that you already get and automatically get. They have some obligation to do that. And so like your S Corp or your partnership returns, they're going to be due on March 15th. Corporate and personal returns are due on April 15th. Those might be a little bit different if you are considered a qualified farmer for tax purposes, but just in general. So, but there may be other things during the year that they're going to let you know about, like the deadline for filing 1099s, the deadlines for W-2s. Perhaps you need to make estimated tax payments during the year. And so they may calculate what your estimated tax payment needs to be, but they're also going to give you a reminder of like when it is due. They'll probably give you the vouchers and everything as far as actually filing that and sending it into the system. So they can help from that standpoint. However, again, they have to have the correct and timely information from the business in order to help with those filings. So without the correct numbers, then their calculations and their estimates and things are not going to be accurate either. And just kind of along these lines, so there are some tax calendars that can make you aware of some of this. So the IRS has had one. I went and looked at it a little bit before this, when I was preparing for this webinar. It seems like that one is under, it's being revamped right now, so it's not available. But your preparer may have a tax calendar that they share with you. It might be even your software provider may have like some tax reminders and things like that. And you can include it in like a Microsoft calendar. It'll automatically send you some reminders and things. The IRS has their interactive tax assistant, and I would say these are really good for just like basic tax questions that you might have. So certainly you could probably call up your preparer and ask these questions, but they're more basic type of question of like, what's a dependent, or what kind of deductions are there, or what do I need to know about like retirement accounts and things like that. So some really like sort of frequently asked questions or some basic information. You may want to visit the interactive tax assistant first. Generally, it might ask a couple of questions about you or like your personal situation or your business, and then it will provide an answer to you based on what you've responded. So it's not to say that your preparer can't answer those questions, but sometimes I would say it might be just as easy to check that, and you might get your answer before trying to talk to your preparer. There are some IRS publications that are really good. The Pub 225, the Farmer's Tax Guide, the IRS Small Business Tax Workshop. That's a set of videos that they're like 3 or 4 minutes, and they go through some basic, really basic tax topics, I would say, on like what are withholdings and what are deductions and what are tax credits and just different things like that. So if you want to learn more in this area, Pub 225 and those small business tax workshops are pretty good. And then just again, our rural tax information and also farmers.gov/taxes. Obviously, maybe you visited already if you're on this webinar with us today, but just want to highlight those again. I do want to mention this because this is not necessarily tax related, but it's sort of along those lines. So the beneficial ownership information, this is a new reporting requirement it started in 2024 at the beginning of the year. Essentially, they are trying to do these informational reports on who created an entity or who created a company or who has ownership in these companies. And that, as it says, it's trying to find, say, bad actors that they've created these shell companies and these different ownership structures through their business to basically hide illegal and illicit activity. So it could be fraud, it could be terrorist financing, it could be perhaps drug activity or something like that. But they've created this requirement on these ownership reports. So fincen.gov/BOI is the official website where you can go and learn more about it. If you had a company prior to 2024, you have until January the 1st, 2025 in order to file this report. If you created a company during 2024, you have 90 days, so almost essentially 3 months from when that company is created in order to file this BOI report. This is kind of like a decision tree that you can see on their website just to help people understand the requirements and whether or not they have a filing requirement. There are some exemptions and there are different types of entities that are exempt. I wasn't going to detail all of that here, but essentially, if you read through this decision tree, if you've created an entity with your particular Secretary of State in whatever state that you are in, a lot of times that's going to be like an LLC structure, then you most likely have a BOI reporting requirement. And you can kind of, as you look through that decision tree, that is kind of what it's showing there as well. But that website has a lot more information. It is filed directly on the FinCEN website. There's not a fee associated with that. I wouldn't say it's an overly complicated filing, but you do need to know like who created the company, who has ownership, just some basic information like that. So they have a small entity compliance guide. There are some frequently asked questions available through the website. So owners can file themselves or request help from their advisors. And so that's kind of why I bring this up, because we know that tax preparers, tax professionals are getting questions about this. Like, can they go ahead and file this BOI report? Tax professionals have to be careful that they are not engaging in the unauthorized practice of law. There's been a question of whether or not this is considered the practice of law. I think generally it's considered, if it's a straightforward reporting, then it is not considered the practice of law. And there are some firms that have already said one way or the other. These are like tax and CPA firms have said one way or the other, yes, we will help with the BOI information, or no, we will not help with the BOI information. And there's different reasons why they may do that. They may not have the time or the manpower to actually help file these reports, or just from a practice management, maybe from a liability management standpoint, they've decided they're not going to help with these filings. So, but I do want to mention it because it is an important filing. It's coming up. That deadline is coming up at the beginning of the year. There has been litigation in Alabama, but currently nothing really has been determined as far as whether or not this is going to be delayed or anything like that. So I just wanted to mention it as we kind of wrap up today. So in conclusion, when you're working with a preparer, just having that frequent and clear communication is important. So touching base with them maybe throughout the year, and not just, hey, I've got to get my taxes done. It's kind of a mad dash to get that information to them. Maybe it's complete, maybe it's incomplete. But I would say, hopefully, as you develop that relationship, you'll realize that they can hopefully add a lot of value to your business. And yeah, there's going to be a cost to their services, and you're going to pay for their services. But I think really, once you develop that relationship, you can see that it is a very helpful service to you. I would say just try to continue to learn maybe about taxes and record keeping and all those things. And they kind of go hand in hand as far as like analyzing your business and making decisions for your business. What's the best path forward for your farm? So taxes are important, but they're not the only consideration. And that record keeping is really going to help from a profitability and an analysis standpoint, and hopefully some of those other situations and things that we mentioned as well. So yeah, I think that was the last slide. So there's my contact information. Hope this information was helpful to you. Perhaps you've got a question later down the road where you'd like to reach out. Please feel free to do so. Get in touch with Janet or Sarah, or just contact me directly. And I think we've got some time here at the end for questions as well.
We do. One question came into the chat a little earlier in the presentation, when you were talking in some of your earlier slides, kind of talking about some of the like record keeping and keeping things separate. And somebody asked about rather than what about instead of contributions, owner loans to their business?
Yeah, so same thing. You would just want to have, just like you would record that loan with a bank or something like that, you would want to record that through maybe an owner's loan to the business. And so, but just having that clear kind of communication between how much was loaned, what a potential interest rate might be and things like that. And so you might have those funds going back and forth between the personal ownership, the personal account and the bank account, but still just having that clear record of that is going to help a lot from that standpoint. And so we do see that sometimes is there are loans between owners to the business.
Great, thank you. And if folks have other questions, please go ahead and drop them in the chat. And just as a reminder, this webinar was recorded. We'll be posting it online. All the materials will be available for folks. It's just going to take us a couple of weeks. Okay, somebody wrote clarify about, I guess, the treatment of loans from owners. I guess what happens, does that dependent on their entity structure? And what if they don't have like a separate LLC for that business? Then what happens?
I think there have to be certain things that are followed as far as like um, because they're related that there are certain things that you can or cannot do in relation to that. But I would say that can happen, but you just have to be careful because they could be considered like a related party. So I think the documentation of that would be important. So um, I guess that's the main thing that I would say about that.
And I guess would that apply if they're a sole proprietor or just have a DBA?
Um, yeah, I guess I was thinking like more for like an LLC type operation, but um, yeah, I mean, I just think it's important to document that, um, and so I think yeah, having that information that is clearly going through the business bank account and that sort of thing is going to be important.
Here's a question. I'm wondering if you could speak a little bit more to the role of a tax professional versus a financial advisor, and um, do people do, does one person do that job, or should businesses have two separate professionals they're working with?
So there is a separate designation, a certified financial planner, that that may be more from a personal standpoint that you might work with, and they would advise you about certain investments and things that you may take advantage of, or they'll look at um, their total net worth or something like that. Whereas a tax professional, while taxes can certainly play a role in your wealth management, unless they have that designation, they're probably just going to make you aware of what the tax implications of certain things might be. So if you have a certain type of entity or if you undergo a certain transaction, what are the tax considerations that you need to know from that standpoint? Whereas the CFP is going to, I think, they're going to make investment recommendations and things like that, and that's not a tax professional is not going to do that sort of thing. They might tell you, okay, if you invest in this, you might have certain capital gains or something like that related to that investment, but they sometimes you might see them have the same designation. They may have like a CPA and also a CFP, but typically they're going to be two separate people.
Yeah. And I would add, those folks can certainly work together. Folks should not be shy about trying to get their financial professionals, their accountants, their attorneys, maybe even their insurance agent, all on, the same Zoom call or in a room together or on the phone to make sure that you are really fully managing the risk in your business as well as using your income and your assets kind of as a wealth building strategy. And all of those folks should be happy to work together or work in a complementary way, even though they are separate professionals.
And it could be that they're even part of the same operation, because I think sometimes people recognize that that's all kind of like financial services and that sort of thing. So it might be two people within the same outfit, you might say. And I think that's a good point about making sure that they are kind of aware of one another, and that this is your tax preparer and this is your financial planner, and so that they can talk, and that sort of thing. Um, but yeah, generally I would think of their duties being split into two separate roles.
And it looks like we have cleared the question queue. So last call for questions, folks. Give it a second here to see if any come in. But if not, thank you all for joining us and have a wonderful afternoon.